Okay. Hey, listen, thanks everyone. I'm real sorry for the for being a little bit late. But I'm Mark from Right Line Trading, and I want to show you one of our core trading systems today. And just really quickly, read the disclaimer that all signals and trading opportunities provided both orally, written, or electronically that are disclosed to visitors or subscribers are for educational demonstration purposes only. Right Line takes no responsibility for any participation by visitors or subscribers within the futures of Forex markets, nor for any profits or losses. Participating in trading in the Forex and futures market does involve substantial risk, and it should be understood that a person can lose substantial amounts of money. Trading is not appropriate for everybody. Always carefully consider your financial position before trading. And Right Line Trading and myself, we're not registered financial advisors, and we're not licensed commodity trading advisors. Now, I want to talk to you a little bit about the oscillator in general as a tool to trade. And I have to move a little bit quick because I started late. Now, in general, I don't think that there's much information out there on exactly how to use an oscillator, irrespective right now of what kind of oscillator you may have on your workspace. If you don't have one, I'm going to show you why it's a great idea to change that. Now, George Lane created the oscillator in 1957, and he was a real brilliant guy. And what the oscillator really does, if for a second we forget about divergent signals, is that the oscillator line, whether it's stochastic, RSI, Williams %K, is making an assessment of momentum. And momentum is another way of looking at momentum is acceleration or deceleration. If a racing car is going around the track at 150 miles an hour, and that speed of the race car is fixed, then momentum is constant. Whatever momentum it has, it's neither increasing or decreasing. But if it accelerates into the finish line, then momentum increases. If it decelerates into the finish line, momentum decreases. And that's exactly what the oscillator is looking at. And what George Lane felt was that momentum changes heralded the change in price. So that when there was a divergent signal and price made an equal high or higher high on lower momentum, that the market would subsequently collapse. Now, if we look at the formula for the stochastic oscillator, it's a real simple formula. It looks at the close of the candle and compares the close with the 14-period moving average of the previous 14 lows. And then there's it can compare it with the 14-period moving average of the highs. Now, on a long move, you want the close to be constantly approaching the high of the candle. That shows momentum is increasing. On a move to the downside, you want the close to be approaching the low. It shows not only that momentum is increasing, but the rate at which price is moving down is also accelerating. That's what the oscillator is telling you. And again, in a market trending upward, prices will close near their high. And in a market trending downward, prices will close near their low. And you want those prices to close closer and closer to the low, or closer and closer to the high. That analysis creates your %K line. And your %D line is simply the 3-period moving average of the %K. So when the K crosses the D, you've got an entry long to the up, or if it crosses to the downside, entry short. Now, in a perfect market, which is really the way the market behaved back in George Lane's day, and we're going to talk a minute why things are so different now. When he saw a double top and he saw a divergence, which means that this top was made on a lower amount of momentum. So in other words, price accelerated faster to this high, but accelerated up to this price more slowly. And that lack of equal acceleration, or the decrease with which price rose in speed or acceleration to this high, would herald a collapse in price. Now, it does come back up and then does collapse. Now, here's a chart that I made recently of crude. Crude makes a higher high, but momentum doesn't increase. So the acceleration or speed with which the market moves up here is equal to the speed with which it moves up here, and a higher price should be associated with a greater amount of momentum. And that heralds a collapse in price. Now, George Lane only used the oscillator to trade divergent signals. He did not use it to trend trade or to track momentum in the direction it was moving, to trade in the direction. He wanted to fade every single trade. Again, in a perfect market, which was probably very similar to the way it behaved in 1957, when the oscillator crosses the 80 line to the downside, get a short signal. When the oscillator crosses the 20 line to the upside, get a long move. Short move, long move, long move. Oscillator crosses above the 20 line, long move. Here it doesn't work, but almost all these signals are successful. Simply looking at momentum, which is the rate of change of speed or velocity. But now, what do we see? The oscillator can become overbought and the market just continues to rise. And if you try to fade the market, or if you trade divergence, you're really going to get beaten up. I mean, I think if you've been trading the market for any significant period of time, you know that many divergent signals will work, but a ton of them don't. And you can't trade a signal that works sometimes and doesn't work others, or a signal in which you can't assess risk. Like, you have no idea when it's going to work and when it's not going to work. And when you have an entry like that, when you have an entry based on a signal like that, it's ultimately going to cost you money. And the reason the market's changed completely from 1957 and when George Lane traded it is really very clear. And it's because when oscillators were developed, there was little institutional volume in the market, which meant that the market price was almost always controlled by the small commercial traders. And the power of each buyer was approximately equal to that of each seller. Now, when that's true, a divergent signal will be a high probability winner. But when you have institutional volume controlling upwards of 80% of price movement in certain markets, fading the market is just going to get you beaten up, because the top is not going to be called by a loss of momentum. It's going to be called by institutional volume. And this is what we need to use the oscillator for, to track price. So I've created a few trading rules on how you have to trade an oscillator and how you have to trade the indicator they're going to show you, which is a really novel powerful system with a Laguerre oscillator at its core. And there is no such thing as overbought or oversold. It's really a fallacy. And if you looked at the NASDAQ this morning at the open, it just kept going down and down and down. As long as institutional money was pushing it to the downside, it stayed oversold forever. So there's really no mathematical overbought, oversold based on an oscillator assessment. Markets will reverse at the whim of institutional money only. Now, price is always going to want to revert to the mean. I mean, that's a mathematical principle that's never going to stop applying. But the concept is a little bit skewed because that reversion to the mean is going to occur when the institutional traders step aside. Now, they've pushed price way up high above the mean, and the mean can be your 50-period moving average or your point of control, whatever indicator you use that signifies mean price or mean volume, it's going to ultimately head back. The further away from the mean it moves, or the farther out of that bell-shaped curve it travels, the faster it's going to snap back to the mean. But it's not going to happen until institutional traders pull their money away, and you're never going to know when that's going to be. So multiple divergence signals are going to get run over. So trading divergence is tantamount to trading against the flow of institutional money. And if you try to do that, you're going to get really beaten up. So you can only trade in the direction of money flow. And the Laguerre, along with another indicator we've combined, is a perfect way of tracking that. Now here's the Laguerre. Now the Laguerre has a gamma factor, which defines the speed at which the Laguerre line moves, and that modifies sensitivity and specificity, and also it has multiple filters. So we've modified the Laguerre, modified the gamma, modified the filters to give us a Laguerre that has speed and stability. I'm going to show you why it just knocks the heck out of all the other oscillators, including RSI, stochastic, and Williams K, and gives you the best assessment of the direction to trade based on its tracking of momentum and how its momentum tracks the flow of institutional money. Now, I just wanted to give you a little bit of an idea. I want to show you some slides, and we'll go to a live chart. Now, the way that we've formatted the Laguerre is this way. When the Laguerre line crosses above the 20 line, you get an arrow on your chart, which never repaints. It occurs intra-candle, so you know to put a buy stop right here, one tick above the close. If the candle closes to the upside, the arrow will print and stay. Nothing ever repaints. Then as the Laguerre moves up and it locks long, that tells you that institutional money is simply pushing the market up further and further and further. Because it's it's putting tremendous buying pressure on the market. And remember, this is a momentum assessment, and it's locked at 100. Back in 1957, George Lane would be looking to fade the market. We're looking to trade in the direction of momentum. Now, you can exit on this arrow, which is when the Laguerre falls below the 80 line, or you can exit on a break of support. Because if you enter on a break of support, you can take this whole trade long. And this is a 30-minute of the Qs. The one thing I want to make clear is it works on any time frame and any financial instrument. Now here's another trade. This is a 60-minute of the Qs. There's your arrow, intra-candle. It tells you that the Laguerre is collapsing. Momentum is heading down. Eventually, it locks short. And through this whole period of time, while it's locked short, right here, you can see this red bar, price just continues to fall. And then you can exit on this up arrow. So we're trading in, what all this is doing is tracking tremendous selling pressure, enough to keep the Laguerre locked down, create this red line, and allow you to continue to trade in the direction of institutional money, not looking for divergence. We formatted this so that its divergence signals are going to be terrible. We formatted this to track the direction of institutional money via the use of its momentum assessment. Now here's a daily of the Qs. There's the arrow. Momentum is shifted to the upside as the Laguerre line crosses above the 20 line. And then when it locks long, it continues to rise. You can exit on a down or on a break of support. That's your call. Or I'm not really giving you I'm not giving you a trade management strategy. I'm just giving you an entry and an absolute direction. How you manage it after that will be based on your risk tolerance. And you see you had another trade right here. The market locked long, and you had a nice move to the upside right here. Now this is a session close and a weekend, because this goes from 6 to 13. Now here's the futures. Same thing. Laguerre arrow shows you the cross below the 20, locks short, and crude just rockets down, out on the arrow. Again, Laguerre short, momentum continues down, eventually locks, red line, continue down, out on the arrow. It's a very, very low risk, high reward trade. Now let's compare it here to the, this is stochastic. Remember, the Laguerre is formatted for stability. The stochastic jumps around. So the stochastic is going to get you in 2 candles early. Right here on this blue line is the cross of the percent K of the percent D below the 80 line. That's going to give you an entry. Here's the Laguerre entry. Flashing arrow, it prints. As the arrow flashes, you set your sell stop 1 tick below the close, and you're in the direction of momentum. Now it continues down and then locks short here and never takes you out of the trade. So you can stay short all the way through until this arrow takes you out. But what happens to stochastic? On this 2 candle retracement, it jumps above the 20 line, takes you out of the trade, and you miss the majority of the move, while the Laguerre stays locked short. And if you trade in this direction, a locked short Laguerre is a stellar time to go short. And there are 2 kinds of trades that we take. One is the Laguerre entry, and the other is the continuation after every retracement of a lockdown Laguerre. Like, we got a retracement here, you can go short here. We got a retracement here, you can go short here, because the Laguerre remains locked short. So there's so much selling pressure here that any place you get in here after a pullback and continuation is a great trade short. And here I'm talking about, here's entry 1, here's a Laguerre arrow. It's a perfect entry. It occurs intra-candle. Now, we only go long above the 50 and short below the 50. It's a little trading methodology. We look for the short trade down and the long trade up above the 50. So there's our arrow long. We're going to take it up. Then we lock long. Now, what I pulled out, I actually covered here, this is a big retracement. And you get a big wick here. But the market's locked long. So all you do is just take the continuation. So the entry is a pullback and continuation. Now, we also put in order flow. I haven't even talked about order flow. So let me quickly switch slide decks. I don't even know if I'm going to have enough time. I think I do. I started at, let's see, 1:30. I don't think I have a whole lot of time left. Hang on one sec. Okay, I have until 2:30. So let me show you the other component of the system. And to do that, I'm going to have to switch slides. So just hang on one second. Because we've combined this with another indicator to provide you with a really stellar entry. And let me just go right down to it. Order flow. Now, order flow combined with momentum, when they're both in the same direction, give you incredibly good entries. Now, I want to review how we assess order flow really quickly. And I know this is complicated and tough to squeeze into 45 minutes, but every candle creates a market delta. And a lot of platforms use order flow, market delta, and they use it wrong. And because unless an assessment is done correctly, it can really knock you around. And I'm going to show you why. This looks at how many traders are sitting on the buy side and the sell side. Not executions, but it simply looks at market depth. Here, there were 2,985 more buyers than there were sellers. That would tell you that there's significant buying pressure in this candle. And you could look at it at tick level or cent level or pip level, but there are more buyers. So the candle is going to close up. The problem is you can get a positive delta on a down candle. More buyers sitting on the dome, but the sellers are more aggressive. So they push price to the downside, even with a positive delta. And if you look at a whole series of candles and their market deltas, you can see that what most platforms do is they assess the absolute value or delta change with this moving average. And it's never going to tell you what price is going to do on the right edge. Because green up candle, green up candle, green down candle, green up candle, red down candle. So what's happening here is that one standard deviation's worth of market deltas work, and then there are outliers that skew the assessment. What we need to do is get rid of the outliers to make the market delta assessment tell us really who's in control of the market, the bulls or the bears. Now, if you assess the delta of every tick level, which some programs do, you're going to get faked out even more. Because here's really what you need to do. You need to throw out all of the data, all the outliers, and just use one standard deviation's worth of data. So what we do is We look at the delta of each candle on the two higher time frames. We don't look at the delta of your trading chart. If it's Renko, we look at the two higher time frames. If you're trading a 2-minute, we look at the 6 and the 18-minute. If you're trading a 5 range, we look at the 8 and the 13 range. We don't look at the delta of your trading chart. And we place these delta values into a 15-period simple moving average. And that moving average smooths out the data, throws out the outliers, and then we look at the slope. And the slope accurately assesses who's in control of the market, the bulls or the bears. Now, when both lines are sloping up, when both lines are sloping up, the bulls are in control, and the order flow line will be green. When both 15-period SMAs are sloping down, the bears are firmly in control, and both SMAs are red. And when the 15-period SMAs are not in agreement, they're yellow. And you see what happens when order flow, based upon the assessment of the market delta of the two higher time frames via the use of a 15-period simple moving average, is green, price is going to rise. And remember, this is not looking at price on your trading chart. So again, it's providing you with an absolute direction to trade. When order flow is red, there's significant selling pressure. Now, if you'll notice, order flow turns before price. Just like momentum changes before price, so does the accurate assessment of order flow. Order flow is going to go green before price turns up, and it's going to go red before price turns down. So these are clear-cut leading indicators. Same here. Price drops, order flow changes to green, price is going to rise. If you try to go against the direction of order flow, you're going to get stopped out 90% of the time. Same thing here. Order flow leads price. Order flow changes on a down candle. The next up pivot, up you go. When it's yellow, no trade. When it's red, it's short. Green, it's long. Now, I know there's a lot of info, and most presenters make the presentation very simplistic and don't provide you with much info. This is giving you a lot of information. And also, the biggest goal of a trader is to avoid, if you think your number one goal in trading is to get winners, you're wrong. The number one goal in trading is to avoid losers. If you avoid losers, you will be a very profitable trader. So you also need a system that's going to define chop for you, help you determine when there's no trend. And when the higher time frames are not aligned and order flow is moving in separate directions, you need this force aligned. This is a force that determines the future direction of price. And price is just going to chop on your trading chart. When it goes green, up you go. And again, if you count your trade against this line, you're going to get stopped out almost always, unless you're lucky. Now, I don't want to go to here. What I'm going to do is I'm going to go here. I hope you can still see this. And I just have to do a quick format here. And we're good. Open this up. I want to change this a little bit. And let me just do this really quickly. Hold on one second. see. And this is going to go in panel 2. I have to make sure this all works. Panel 2. This is going to go in panel 3. And I'm sorry, I traded so long in the live trading room that the gear is going to go into panel 4. No, I'm sorry. That goes into panel 4. And our 3 line is going to go into panel 2. And hopefully I got it. And I do. Now let me just separate this out. I don't have it exact. Just give me one more second and we're good. I still have 8 minutes, which is enough. Okay. And let me just change the way it's formatted. Actually, this will actually work okay. So here's what we're looking to do. This line right here is order flow. Let me show it to you. Right here, this top line. It's doing what I had told you it was going to do. Assess whether there's an abundance of buyers or sellers, and it's doing it on a multi-time frame basis. And it's going to tell you whether there's significant buying or selling pressure in the market. This line is now we're doing a gear assessment on a multi-time frame basis. Now what we're looking to do is only take a gear entry, like right here on this arrow, when we also have this top line, which is order flow. So we want order flow and the gear to align. And we have a perfect up trade. And this is going to keep you out of a million bad trades. Now, if you look right here, this keeps you out of this loser, keeps you out of this loser, keeps you out of this loser. Right here is where we have the gear locked down and order flow red. And there's your trade. And all of these are censored. And they're all losers. Right here. And look at this. Yeah, now sometimes you just have to look at the slope of the gear. But if you just want to look at a lockdown gear, right here. Pull back, continuation. Order flow is red, gear is red. Right here. Pull back, continuation. Order flow is red, gear is red. And you can see the gear line locked at the bottom. Right here, pull back, continuation, you have no trade. Order flow does not let you take this trade. You're going to have to sacrifice an occasional winner in order to sidestep all the losers, which is what always happens when you trade with a lot of specificity. This long, right here, the gear locked long, order flow, perfect entry. Then would you take this trade up? Look at order flow, it's yellow. No continuation, no continuation. Then order flow rolls to the downside. That's your direction, but these losers, you're not taking continuation trades. Here to the short side, you don't have a trade. Right here, perfect short. and down. So all we're doing here is combining the multi-time frame assessment of order flow. And now this is a multi-time frame assessment of momentum. And when momentum and order flow align to the upside or the downside, you've got yourself a terrific trade. When they don't align, you can't trade. And some winners are going to skip past you, but you're going to avoid an enormous number of losers. And that's all that matters, because all we're looking for are low risk winners. Here's another big winner on the E-mini. Continuation, order flow, and the Laguerre locked red. Here you don't have a trade. Here's a loser. And this is the first loser I found. I don't want you to think you get 100% winners. Now, let's take a look here. Here, any pullback on that wick and continuation, you can take. Because once you get a wick and buyers try to turn the market and fail, the continuation is almost guaranteed to trade in the direction of order flow and the multi-time frame Laguerre. Now let's look for a Laguerre arrow entry, because we call that our number one trade, and the pullback is our number two. You can see you get them right here. Winner, winner. Long, winner. Now this one doesn't work. You don't have any trade here. And you don't have any trade here, and there's your loser that you sidestep. Now I'm doing this on the E-mini, and you can see all of the trades. Now there is your perfect, well, you don't have your perfect entry because you don't have order flow. But right after the Laguerre arrow, 2 candles later, you're here. Look at the slope of the Laguerre. It's just heading down like a rocket ship, and down you go. There's very little nuance. You trade in the direction of momentum with order flow in your direction as well. And all of these short trades are great trades. Right here, continuation. Well, you don't have order flow. You need that. And order flow is choppy here. Here's your trade, right there. Pull back and continuation, right there. Here, if you want to take the trade down, you have no order flow. Yellow. Can't take it, and it's a loser. So you can see the tremendous amount of specificity you have. Now, these forces, I only have another couple of minutes, move price on any time frame, on any financial instrument. They all obey the rules based on order flow and momentum. It doesn't matter whether you're trading stocks, futures, or Forex. I showed you slides of a 30-minute, an hour, a daily. It's irrelevant. They all obey these forces. These are what control the direction of price. Now here's the system that I'll take 1 minute to answer questions. It's $6.99 for a lifetime license. It's normally $19.99. Now it's really a terrific system to confirm an entry. You want to trade in the direction of the multi-time frame assessment of momentum. You want to trade in the direction of the multi-time frame assessment of order flow. It's a tremendously powerful assessment of buying pressure and selling pressure on price on the right edge. And it's going to determine out into the future how price is going to move. If you try to counter trend trade these forces, you're going to have a problem. You also get a month in the training room with me. You get a 10-module educational training series, and you get 450 videos. And the first 5 orders get our pivot indicator. And I did not have time to go over how great it is, but it's really a terrific indicator. Now, I think this is a wrong date. I changed it, but for some reason it didn't save. It's Sunday. And I think Sunday is the 11th. No, Sunday is the 10th. It's Sunday, March 10th is when it expires. But the first 5 get our pivot indicator. Now let me see. Rory, is that the right URL for the special offer? rightlinetrading.com/special offer. Okay, the link is in the chat box if you're interested. And let me just quickly go over, take 2 seconds to go over any questions. And I know I'm running over and I don't want to be disrespectful. This isn't going to be applied to stocks, to anything. Gee, it's a good question. You have to look at the whole system, GJ, in order to determine when both order flow and momentum align. Now, on Thinkorswim, it is only for NinjaTrader 7 or 8, but we can take your data feed from Thinkorswim, attach it to Ninja, which we do for you. We format everything, and it will run Ninja. We have a ton of Thinkorswim traders who trade a demo of Ninja using their data feed, and they pay nothing. So basically, the cost to you to run the Ninja is 0, and you're going to trade it off of your Thinkorswim platform. That was today's chart, PRL. Yes. Okay. Last few questions, and then I'm going to have to go. And because I know I'm running over. Again, hold on one sec. So repeat, please. Where would we put the stop? Is up to you, but I take it on a reversal candle. The entries are clear. The exits, Tucker, you can take them on a gear arrow up or a reversal candle, depending upon your risk tolerance. If you come aboard, I'm going to work with you. We give you a complete automated trade management strategy, the same one that I use in the live trading room. So it comes complete with all of that. The trailing stop, your best targets, and it doesn't matter. We're going to give them to you whether you trade stocks, Forex, or futures. You'll get all that. Hey, Les. No, it's a completely different system, Les. Completely different. And it works on Ninja 7 or 8. If you have Thinkorswim or Awanda or a few others, we can bring the data feed over and can run it for nothing. You can always run the demo of NinjaTrader for free, and you can get a demo data feed. So you can still run Ninja. If you have any other questions, just give us a call. Here's our number, 786-713-5276. We're here. But I'm going to have to stop, and I really thank all you guys and ladies for coming in and giving me your time. I know I squashed a lot of information into a really short presentation, but this is really the core. Trade with order flow and trade with the multi-time frame assessment of momentum. The fact that it's looking at multiple higher time frames is what gives it its forward-looking ability and really its power to tell you where price is going to move out into the future. Thank you so much. I apologize for the 5 minutes, and I wish everyone the best of luck in their trading. Thank you so much. Bye-bye.